In this week's video, I want to go over a topic that is going to be very prevalent in the next couple of years. So, the mortgage rates in the last 3 years have changed significantly. If you're following real estate in any way, we all know that the mortgage rates have skyrocketed from the lows of 1.10 for a variable rate all the way up to, if you're on a variable rate right now, you are over 6.5%. So, the payments have substantially changed, and some people are really, really feeling the pinch, or they are being forced to sell their homes when that was not the intent at all when they purchased it less than 3 years ago. So today I'm going to actually show you the difference between what your mortgage was 3 years ago versus what you'll have to be refinancing at if these current rates don't change at all. So let's stay tuned here and I will plug in some numbers. So let's pretend you bought a house outside of the GTA, and that's just going to be for the land transfer tax portion of it. But let's say you spent $800,000 on your property. You put 20% down. So you put 160 grand down, let's just say, for example. So your total mortgage would have been $640,000. Your average person was taking a 25 or a 30-year term. Let's use the 30-year term because it has been more popular among my clients recently. And let's say that they originally had a rate of, let's just be generous, 3% was their mortgage rate. Their payments would have been $26.92. That would have been back in 2020 or 2021, for example. Now, let's say they did a 5-year term. Their mortgage will renew in less than 2 years now. And the current rates, if we customize this once again here, you're seeing these posted rates are significantly higher because you're putting over 20% down. Let's just use 6% as our baseline. So your monthly mortgage payment is actually going to jump up to $38.07, so $1,200 more per month if you were at a 3% and you're now at a 6% mortgage. Some people were significantly lower than 3% on a fixed term, and some people were slightly higher. But this is a $1,200 difference between what your mortgage is now and what it could potentially be in a couple years. And this is just looking at the mortgage payment. That does not take into account property taxes, home insurance, any of your utility bills, getting your groceries. And this is the cheaper route. This is a 30-year mortgage term. Let's say we did a 25-year term and we had 3% once again as our previous rate. Our mortgage on 25 years at 3% fixed would have been $3,029. Okay, obviously more than your 2,600 because it is a 25-year term, but now let's turn that into a 6% in 5 years. So you are once again increasing your monthly payments over $4,000 a month, $4,100 almost here. So as we can see, we've got a big issue. So as you can see, it's not a understatement when I say that there's a lot of people who are going to be in a rough situation in the next 2 to 3 years. And this is only if somebody was on a 5-year fixed mortgage. Some people decided in 2020 or 2021 that they would do a 3-year fixed mortgage, hoping that they'd be able to get a better rate when their mortgage came up for renewal. Unfortunately, those are the people who are going to hit the market first and have to either refinance their mortgage at a significantly higher rate because that 3-year term is expiring in 2024, or the people who had that 5-year term are going to be expiring in that 2025, 2026 year, and we are going to have something that I don't think people necessarily expected ever happen, and that's the potential of people who bought their first house. Maybe they bought a detached property as their first house because the rates were low and they could afford it. But these people are now going to have to actually downsize because they can't afford their current mortgage and how the refinancing is going to work. Imagine you have a 3% fixed mortgage right now for 5 years. Your payments are fantastic. You're very comfortable making those payments. You're a teacher. Your wife works at the bank. You have fixed incomes coming in. So you know exactly what's coming in, what's going out. You know all the numbers and the way they work. Now, let's imagine you're refinancing and now your payments have increased $1,200 per month. Both of those jobs are not jobs where you can just make more money. You're not self-employed like myself, for example, who, if you're self-employed, I could work harder, do more work, and try to make up for that increase in the monthly payment. But most people cannot. They are not going to know what to do with themselves when they all of a sudden have an increase so substantially of potentially $1,200 a month, depending on the mortgage size. This is obviously a one case scenario of a $650,000 mortgage, but this is not at all out of the norm from what I see from my clients. So it's a very realistic situation. And the hope is that when these renewals come up, hopefully the Bank of Canada has at least lowered the fixed rates to a point at which people can stomach and make their payments. If you're in the position where the current rates are already a pinch, how are we going to afford that refinancing payment? And the hard conversation that a lot of people are going to have with themselves is, what do we do in this situation? Do you sell your property that you worked so hard to save up that down payment for, knowing that the market now is not what it was in 2021 or 2022? You're likely selling your property at a loss as well. So that is not an ideal situation. You don't want to sell your property at a loss. So you are going to do everything you can to hold on to this property. And that means you're going to make the payments. You're going to struggle and suffer and have to cut back on a lot of the luxuries because you don't want to sell your property that you worked so hard to acquire. I am struggling with the way things are going to work here on these renewals in the next couple of years, and I'd love to know your thoughts. I'd love to know if you think this massive increase in mortgage payments for people on their renewals and for their refinancing is going to cause a collapse or a suffering in the market, or do you think the banks are maybe going to have some leeway for people, give them other alternatives so that way their increases are not as high as they are? Me personally, I don't know how a lot of people are going to be able to survive going from one number to the next, knowing that there's such a massive increase in their monthly payments. It just doesn't compute. It doesn't seem like something that's going to be very easy for people to stomach or get through. And imagine you've got young kids, you're still trying to keep the roof over their head, keep them in maybe the same school district. There's a lot of different things to consider. I, for one, hope that we're able to get through this, but I do know it is going to be a tough time for a lot of people. I hope this video was eye-opening for you, and if you had no idea that the rates have changed this much because you've been enjoying your fixed mortgage for the last few years, I caution you to just be careful with what you're spending, look at your numbers, be aware of what your renewal could potentially be, and think about how you are going to tackle that situation, because it's not something that you want to just get your paperwork from the bank that your mortgage is up for renewal, and this is your new rate and your new payment, and you are just mind blown. Be prepared for what's coming. I thank you so much for watching this video. If you liked the video, if you found it helpful for you, or if there's somebody you know who needs to hear this information, pass the video along to them. Don't forget to like, share, and subscribe to the channel. And I'll see you in the next video. Bye for now.